All right, let's get started. My name is Nick Stewart, and I'm the Institutional Investor Relations Lead at AngelList. For anyone who's unfamiliar with AngelList, we are a software company with a mission to accelerate the rate of innovation. We believe that startups and those who invest in startups are crucial to this mission. We accomplish it through building infrastructure to power the startup economy by providing investors with tools they need to launch or scale their fund. This ranges from full service offerings for first-time or emerging managers to helping established firms streamline their fund operations. Before I introduce our guests, I want to cover some quick housekeeping items. First, our speakers have graciously offered to participate in a live Q&A towards the end of the conversation, so we encourage you to submit your questions in the Q&A chat box below throughout the conversation. Second, this conversation is being recorded, so we'll be sure to share it after the event in case you'd like to watch the conversation. Find interesting. With that, let's move on to our guest speakers. So I'm very excited to be joined today by Liz Ferry of StepStone Group and Graham Pingree of Cendana Capital. Thank you both so much for joining. So before I jump in, yeah, awesome. So before I jump in to have you guys give your personal intros, I want to share a quick overview of your organizations for the listeners. So I'll start with StepStone. StepStone Group is a global private markets investment firm focused on providing customized investment solutions and advisory and data services to its clients. As of this past December, StepStone was responsible for approximately $698 billion of total capital, including $179 billion of assets under management. StepStone's clients include some of the world's largest public and private defined benefit and defined contribution pension funds, sovereign wealth funds, and insurance companies, as well as prominent endowments, foundations, family offices, and private wealth clients, which include high net worth and mass affluent individuals. For Cendana, Cendana is a fund of funds that provides strategic high conviction capital to very early stage VC funds globally. With over $2 billion in assets under management, Cendana has backed more than 4,800 companies, including over 130 unicorns. Cendana's investment strategy focuses on partnering with seed and pre-seed venture capital firms that possess unique networks and domain expertise, enabling access to exceptional founders. By emphasizing portfolio construction, network strength, and the intangible qualities of fund managers, Cendana aims to generate meaningful value for its investors. Last month, they also announced their $400 million Fund 6 to continue to back early managers across the globe. So to hand it off for personal introductions, Liz, I'll start with you.
Great, thanks, Nick. Hi, everyone. Thanks for having me on this panel. So I'm Liz Ferry. I'm the head of ODD at StepStone. I've been at StepStone 6 years, and prior to StepStone, I was at Goldman on their ODD team. I've been doing ODD 15 years, and I started my career at KPMG in London, auditing private equity houses. So I've been in the financial services space for about 20 years. So I'm excited to be here. Thanks, Nick.
Awesome. And for our listeners, ODD, operational due diligence.
Operational due diligence,
we'll jump into it, which I'm very excited to do because we'll tell the group more about what that is. And Graham, you're up.
Wonderful. Yeah, thanks so much for having me. I'm a partner with Cendana Capital. We, as Nick mentioned, are an early stage venture fund to fund. I've been on the institutional limited partner side for most of my career, starting in the early 2000s with Cambridge Associates, and then was with another large fund platform called Horsley Bridge Partners for getting my MBA and trying my hand at operating. So I worked for a venture-backed startup for a few years before returning to the investment side, joining my partner Michael, the founder of the firm, more than a decade ago. I used to be out in the West Coast, but moved home to Boston in 2017 and kind of manage our East Coast team from here. But awesome. Pleasure to be here.
Thanks so much, both of you. All right, well, let's kick things off. So both of you spend time acting as trusted sounding boards for early stage GPs and often play a crucial role in core decisions that managers make when structuring their fund. So I'll start off with you, Liz. What are some of the table stakes characteristics of a fund, whether it's structure, LPA terms, operations, or anything that are non-negotiable for your firm when looking at investments?
Great, thanks, Nick. So there's a couple of angles. So from an operational due diligence standpoint, it's, we need to see dual signatories around cash. That's a deal breaker. We want to see D&O, E&O insurance. We want to see segregation of duties between the investment and the back office teams, 4I checks on all the key incentive fee, management fee calculations, things like that. But one of the sort of trends and areas that we've been engaging most with our GPs over the last 12 to 18 months, I would say, are conflicts of interest related clauses in the LPA. And predominantly around fees, the use of transaction fees, monitoring fees, affiliated entity fees, the charging of back office fees that are typically covered by the management fee back to the fund. And so we spend a lot of time digging in to the use of these fees. I'm not saying there aren't mitigants, is there LPAC approval required? Are they doing external benchmarking to make sure that the fees in market or below? Are they properly disclosing the practice in their LPA? Are they doing proper allocations to make sure the right funds are being charged for the services being provided and things like that? What I would say is at StepStone, there really isn't one deal breaker. It's usually the totality of circumstances that will inform our decision as to whether or not we can move forward. We're a solutions-oriented business, so we really do try and work with our GPs to get to a point we can move forward. And where we're working and engaging with our GPs around off-market practices or policies or terms, it's not just for the benefit of ourselves and our underlying client base, but for the larger LP base too.
Great. Awesome. And maybe digging a little bit more into controls. Why are controls so important, especially for a small fund with a smaller team?
Well, is that for me or for?
Yeah.
Yeah, okay, fine. So having a proper control environment gives us a lot of confidence that there aren't going to be mistakes in the disclosures being made and the reporting being made to investors. So bad performance, you can usually explain away down to the market environment, but operational failures are going to erode trust and your LPs aren't going to re-up because that is something that as a mindful and thoughtful owner of the business, you can put mitigants in place to avoid that happening. And that's what we as an ODD team, also known as the odd team, are hoping to help you be able to accomplish.
Awesome. Thank you so much. So sticking with early fund formation, I think there's a big difference between a fund that's easy to diligence and one that creates friction, as you've just talked about. For Graham, based on your experience, what are some of the seemingly small things that managers can do that actually make a huge difference in the eyes of institutional LPs when you're first getting your hands dirty looking into their fund?
Yeah. I mean, look, I think ultimately fundraising is a sales motion, and I think the best fundraisers are, adept salespeople, and one of the key components of that sales process, I think, is listening to your prospective client. And so what I find is GPs who pitch me and are kind of attentive to and reacting to the feedback that I'm providing, it just makes such a big difference. And not everyone does that. I think some have a refined pitch that is fairly rote and it's very scripted. The ones that honestly I feel like build a real connection with LPs are the ones who say, okay, I'm aware of Cendana's particular tastes and the characteristics that they look for, and I'm adapting my story and reacting to that. So I think that honestly goes furthest of any like fundraising technique, is listen to the person that you're pitching and react to what they're telling you about what they look for.
Great. And one more question for you, Graham, but Liz, you're welcome to jump in after as well. How can GPs make ongoing partnership easier and more transparent for LPs? So sort of post that commitment being made.
Yeah, I mean, data sharing is critical, and like open, honest communication are probably some of the most important things in forging a relationship with a limited partner. We tend to be the largest LP in the funds that we back. We're often the first institutional LP to commit to funds, so we're working closely with the GPs to help put the right processes in place around information sharing. We track a lot of data and have kind of high expectations for the way that data is shared. And so I think we try and communicate that early in a process, and prepare our GPs for kind of that onboarding. But for us, yeah, that kind of like frequent communication, transparency around data sharing, And honestly, that's true for GPs that aren't in our portfolio. You know, if we have been pitched and kind of share reasons why we're not going to get there, but the GP wants to stay in touch and have a conversation for a future fundraise. I think the ones who like thoughtfully communicate, and again, back to my first point, say, okay, well, here are the reasons that Cendana didn't get there. You know, in 6 months, I'm going to come back and say, hey, you mentioned that you wanted to see our ability to write bigger checks. Like, here are the last 3 companies that we've led, and here, you know, here's how we've been able to execute on this adjusted strategy.
Awesome. Cool. Well,
Yeah,
go ahead.
sorry, I would back exactly what Graham's saying. I mean, and it's timely. Get in front of any big news items, so we're not reading about it in the news, especially if it's something negative. So regular, frequent, thoughtful transparency and updates is what we really appreciate.
Great. Well, Liz, I'll jump back in with you more on evaluation, like you were just talking about. So I know each of your teams backs firms of different sizes and maturity. So Liz, we hear from a lot of large LPs about the importance of operational readiness and ODD for funds, which, you know, LPs like StepStone evaluate through ODD. Can you talk about how you balance scoring managers that are at the very earliest stages that your firm does versus much larger, more established firms? How does that vary, and how do you adjust?
Sure, thanks. Yeah, so we have a very large VC platform at StepStone, and we do invest in solo GPs, and we do invest in what we define as kind of emerging managers raising between 100 and 300 million for their first fund. And so what you can expect from them from an operational perspective is very different from one of the larger established private equity buyout managers. And so when we acquired Greenspring, the Greenspring platform, a huge VC platform, 3 or 4 years ago now, we had to think about how we could thoughtfully and effectively ODD these managers. And so we came up with a product called Operational Alpha. And it's where the ODD team gets in super early, 3 to 6 months before we're going to commit capital to work with the emerging managers. We have a playbook we give them. We share with them what their operational and regulatory requirements are from day one. We have policies and templates we provide to them to help them put in place the policies and procedures we want to see. We talk to them about having to hire a third-party fund admin if that's necessary. If they're a solo GP and they need to have dual signatories around all cash movements, so the admin initiates, they can approve. And this program has proven to be super successful. The GPs love it. It really helps with our partnership approach. It's led to board seats, even though we're not the largest allocator. It's also led to bigger allocations to oversubscribed funds. And so for us, the key is we do have minimum ODD standards. We have an institutional client base. They have a super high bar. So they need to be able to meet those for us to be able to get comfortable, but we work with them to get there, I would say, is the key differentiator. Whereas when you're working with a more established fund, most of the time they've already put that in place. So it's a tweak or, you know, we have a database, we track 1,200 GPs and what we see as emerging trends on the ODD front. And so it might be that they're they're an established manager, but they're in the real estate space, and we say, you know, 93% of our real estate managers use a third party to value the book once a year, not a percentage every 3 years. And we can use that to try and promote best practices amongst them. But usually they have a number of those already built in. That's how they got to the level that they got to by scaling their business.
Yeah, I love that. I think that advisory support is huge, and I think it's a compounding competitive advantage for you guys to be able to set the standard for what people need. That's great.
Thanks.
Awesome. Graham, moving over to you. I know Cendana focuses on 3 like core attributes for the managers they back, and maybe you could give a quick overview of those, but then maybe talk about how you know, the bar for evaluating managers from fund 1 to fund 2 or fund 2 to fund 3 changes. How does that standard get set as they graduate to a new fund?
Sure. Yeah. I mean, we have some structural criteria that we use to evaluate funds. You know, we target small, largely emerging funds. So it's usually below 100 million in vehicle size, usually a fund 1, 2, or 3. And pure early stage strategies, which is to say all the first checks are going in at pre-seed or seed, typically biased towards relatively low reserve ratios. So we spend a lot of time thinking through portfolio construction and talking with our fund managers about whether we think this particular portfolio construction optimizes for returns for the spaces that they're going after. We're also very keen on, I guess this is probably true for most institutional limited partners, but what is like unique and differentiated about this strategy that we think is going to create a long-term sustainable advantage? So sometimes that's something specialized about the sector that they're focused on, or it's a thematic approach. But we're often looking for something that's unique and is going to allow this manager to stand out in an increasingly crowded market and get access to the very best founders. And then I think you were asking about what changes for an emerging versus a slightly more established fund manager in the way that we evaluate. Is that right?
Yeah. What would it look like from fund 1 versus fund 3, for example? I don't know if I lost you there.
Yeah. Yeah. Sorry. Hopefully I'm back. I think it's not dissimilar from evaluating a pre-seed company versus a Series A or B company, right? Like now there are actually metrics to evaluate when you're raising a fund 3. So we spent a lot of time looking at fairly granular performance benchmarking, and we're evaluating how they've executed a strategy against our proprietary data set. So there is a lot of fairly granular benchmarking that happens in a fund 3 that's just impossible to do in a fund 1 or even a fund 2. And at the end of the day, I think one of the things that LPs care a lot about is execution. Did you do what you said you were going to do? Or has there been material style drift? And that's something that we spend a lot of time paying attention to, because we're looking for fund managers that react to the market, but are also executing on a strategy that they laid out to us.
Great. That's awesome. Liz, I'll jump back to you. I know you just talked a lot about your evaluation criteria for managers, but I'd love to know if there's a single most overlooked area of institutional readiness from like an operations perspective that you'd love to basically tell GPs, like, this is something you should think about way earlier than you think you should.
Sure. So what I would say is picking the right fund formation counsel is key. So we all know there's 4 or 5 big legal firms that dominate the market. And the cost of using any one of them can range from 400,000 to $1 million for a first-time fund. But there is an established market out there for what we expect to see in the LPA terms, especially for an emerging manager. And the balance between GP LP friendly terms, it swings between whether or not you're an emerging manager or an established manager with an established track record and a predictability in the performance that we're expecting to see. And so for us, it's going to make it a more efficient negotiation process during the fundraising period if you do have what we consider market terms. And so by not going with a fund formation counsel that has expertise in this area, you're likely to have inefficiencies. It's going to make the fundraising process painful and a lot longer potentially. And also you're going to be running the risk of having off-market terms, which, LPs just are going to push back on.
That's great. Yeah, and I'm sure Graham's side could also agree with that as a pretty important attribute to have.
Certainly. Yeah.
Awesome. Well, Graham, I'll shoot back over to you. But Liz, you're welcome to jump in as well if anything sticks out. I'm sure you both uncovered surprises during investor due diligence. When you're bringing the deal to investment committee or trying to wrap up diligence, can you share some red flags, whether subtle or glaring, that signal pause or pass from your groups?
Yeah, for us, I mean, look, we won't compromise on like anything ethical. If we feel like there's deception or dishonesty, that's an immediate deal breaker for us. And I think that there's obviously a spectrum of exaggeration to pure deceit, but we look for people who are really authentic and transparent. And we spent a lot of time kind of triangulating, like, did they do what they said they did? Is their track record representative? And we talk to a lot of founders and try and corroborate a GP story. And anytime we hear something that is contrary to what we've been told, that will immediately stop a process.
Be honest, makes sense.
Yeah, simple, right?
Yeah, sounds simple. Awesome. Well, let's zoom in a bit more to trends in the market. So, given how quickly the market evolves, I think it'd be great to hear more about, some of the aspects you guys see. For Liz, what are some macro or micro trends, whether they're regulatory or technology, structural, that are top of mind for your team as you're evaluating funds?
Great. Thanks, Nick. So I'd say at top of mind right now from a regulatory perspective is it's an ever-changing environment. Are we moving to a period of deregulation with the current administration? The private fund rules were vacated last year. I think we also saw in the news the SEC lost 15% of its staff last month, over the last couple of months. Are they even in a position to effectively, check the markets and review the markets? And so this is stuff that's still out of our control. So what we are focusing on with our GPs are what are the regulatory requirements coming down the line and how are they preparing themselves for it. So the AML, KYC regulations coming out of FinCEN, they're going to go into effect 1 Jan 2026. The amendment to the Reg SP that came out last year that's going to come into effect for different investment advisors between the next 12 and 18 months. What's that about? It's making sure that you're keeping investor information protected, the confidential information, the PII. And how are you doing that? By putting in place robust cybersecurity processes and policies. So that's kind of one of the areas. We're just making sure our GPs are prepping and going to be, in line with their requirements as and when they come into fruition. Another trend that we've noticed is, especially in the VC side, is the LPAs are becoming more GP friendly. And we are seeing more clauses shift that way. And the reason being, like Graham pointed out before, it's the demand. And, a lot of investors are trying to access the space. And so that is something that we are spending a lot of time negotiating with our GPs, especially the emerging manager ones. Because again, there is that unpredictability. They don't have the established track record. And so, we do kind of see a difference there, like I said, between the balance between LP, GP friendly terms.
That's great. And on the regulatory side, I imagine for a manager that's just kicking things off, this is probably a total black box for them. What are some of the steps you recommend they do to get ahead of that as they're starting a fundraise? Is there like a hire or a group? I think your support is great, but even before they start talking to you.
So, it depends on the size of the firm and how many employees are at the firm. So, if it's a solo GP, there are 5 compliance policies and procedures we think they're required to have under an exempt reporting advisor registration with the SEC. And we work with them to have those in place. But if it's only 2 or 3 GPs, it doesn't necessarily make sense to pay a third-party compliance consultant or have a compliance officer in-house, because really the monitoring isn't going to be arduous. You're all GPs, you're all sophisticated, you all are aware of what's required of you to meet your fiduciary duties. So it would be, as they continue to scale. So maybe Fund 3, they have a team of 15. They need to start, they've raised 500 million. They need to start thinking about hiring a third-party compliance consultant then to help them meet their regulatory requirements.
Great. Thank you. Awesome. Graham, I'll shift over to you just on the fundraising environment more generally. Your firm just raised a new fund, so I'm sure you're innately familiar with how hard it can be in the environment today. And I'm sure a lot of the managers tell you about it all the time. What advice would you give to first-time managers who are doing their first real institutional fundraise in this day and age?
Yeah. Look, there's no question it's a challenging market to be raising, for an emerging strategy. I think the biggest advice is patience. Like it can take a long time to get first and second time funds off the ground. Don't expect an overnight success. and make sure you're committed to doing this and doing what it takes to make it happen. Because I think, especially in a market like we're in today, it's going to take longer than you think it is. As far as like specific tactical advice, I think kind of qualifying your top of funnel, like make sure you know which LPs are best suited to back a strategy like the one that you're targeting. So if you're raising a $50 million pre-seed fund, going to Harvard or MIT or any of the huge allocators, there's probably a structural mismatch there because they have to write substantial commitments. So really try and vet the prospective LP list to find the ones that are going to be a fit.
That's great. Thank you. I'll keep with you, actually. I think liquidity is also sort of an elephant in the room right now for funds, with IPOs and secondary market. How's your firm's thinking around fund liquidity or exit timing changed over the last couple of years? Are LPs pushing for changes in structure, to your fund, or for, the funds that you're in? Are you guys thinking about how to address this?
I would say no structural changes that we've observed, minus some of the bigger platforms changing to more of a holdco structure, like the Sequoia transition a couple years back. At the seed end of the market, we don't see anything that dramatic. I think the reality is, though, secondary liquidity has created a whole new valve for small managers to generate DPI. It's not something that existed a decade plus ago as a meaningful source of liquidity, but today, because companies are staying private ever longer and there's seemingly limitless supplies of private capital to support that financing path, what we've observed is small seed funds can, partially trade out of positions at Series C, D, E, F, G, and return substantial capital back to their LPs. So we think, even if the IPO market remains challenged, obviously M&A, I think with some regulatory shift, you could see an uptick there. But we think that secondaries of growing importance, and like that's like a long-term trend that we don't see reversing anytime soon.
Great. Liz, I'll shift it over to you. Similar fundraising topic. It seems like SPVs are becoming increasingly useful as a co-investment tool. How do you think about managers using SPVs as part of their strategy? Are there any strong pros and cons that you've seen, or any other observations?
Sure. So for SPVs, there's lots of different reasons why you'd set one up. So there's tax, there's regulatory, and to your point, the co-investment model. There's also aggregator SPVs where it's more efficient to have one name on the cap table versus 15. It gives you more access to some of the deal flow, and it can also help you, give the access to your SMA clients and things like that. So we use the aggregator SPV model a lot at StepStone because we have a number of funds going into the same deals. But you also see the overflow SPV, which is, I think, what you're alluding to on the co-investment side. And that comes with it, potential conflicts of interest, especially if you're an emerging manager. You have to be able to explain that the fund has taken its full capacity before you're opening it up to external investors. And there is a cost element to setting up an SPV too. So what I would say is we use SPVs. They are an important structure in the investment process, but there are a downside, like costs, conflicts of interest. So really you have to think about, the use case for that SPV structure.
Great. Awesome. We're close to wrapping up and going into live Q&A, but I'd love to just do a couple quick rapid fire questions. No more than a sentence or two from each of you. I'll start with you, Liz. What are some personality traits or working styles that you've consistently observed among the most successful managers your firm has worked with?
So I'd say the most successful managers have founders who want to work with them. And they don't just rely on their pedigree. They are hard workers and they do grind to get that deal flow. So I'd say that, and I'd say, you know, they take a long-term view on their business. Like Graham said earlier, you know, fund size matters. Don't go for the largest fund for your first fund. Start small, be nimble, get that deal flow, get that track record, and then grow your firm as your track record grows. Same from an operational standpoint, have a long-term view. You're going to want to scale this business. So do what you can to put in place an institutional platform from day one.
Great. Awesome. I'll shoot it over to you, Graham.
I failed miserably at the 2 sentences.
That's totally
I'll
fine.
do better on the next one.
One-ons are acceptable. Graham, what are some common misconceptions that emerging managers have about institutional investors that you wish they understood better?
I mean, I think, look, from the perspective of both StepStone and Cendana, like we have to go raise capital ourselves. So we empathize with the fundraising journey. We recognize that it's a challenge. We're never intentionally, you know, dismissive or you know, we just know how hard it can be to go raise capital. And so I think, you know, we try and show that empathy, you know, when we talk to GPs. Maybe it's not always obvious, but you know, we're in the same boat as you all. We have to go raise capital too.
Right, right. And I think GPs have to know that perspective too when they're talking with founders. So I think it all the way
Right.
down. Awesome.
Absolutely.
Well, thanks so much for those answers. We're going to take the last block of time to address some of the questions that were submitted by listeners. So, and folks, you can continue submitting questions if you have them. Before diving into that, we are going to shoot up a quick poll just on people's screens if you're interested in learning more about AngelList and our fund offerings. If you check it off, we'll be in touch and we'll be sure to reach out. So yeah, feel free to do that. So jumping into the questions, I'm just going to start scanning with my team. So first one's for Graham. How can solo GPs make themselves stand out without the benefit of large operational team or legacy track record? And zooming out, what's the best way in general, or at least in your case, to reach institutional investors? Do cold emails work? How does most of your deal flow reach you? So a couple questions buried in there, but I'll let you tackle it.
Yeah, I'll go backwards. We try and respond to cold emails. You know, we recognize that not everyone has the same kind of level of connectivity and access in this industry, and so we do try and be responsive there. That said, I think transparently we have a probably lower conversion from the cold email funnel versus a trusted introduction where one of our GPs or another LP can really vouch for a GP. So open to both, but I think a warm intro is always better if you can get it.
Sure.
And then, sorry, what was the first part of the question, Nick?
Yeah, so the first part was how can they stand out without the benefit of large operational team or legacy track record?
Yeah. Look, this is a fundamental question because I think standing out is critical. I think each GP has to focus on the element of his or her strategy that feels unique and is going to feel accretive to a prospective LP that you're pitching, so that when someone hears it, they say, oh, wow, that's really different from the exposure that I've already built in my venture portfolio. I could see how this would be really beneficial, and it's something I would want to add. So really honing like what is different about your strategy versus the thousands of other funds that are out there. And I think that can be done without a super deep track record. It really is about storytelling.
Awesome. Thank you. Liz, over to you. We're hearing from more solo GPs who are gaining traction and thinking about how to scale. When it comes time to institutionalizing, who do you think should be the first hire and why?
So I think for solo GP, the first hire is probably going to be a third-party fund admin or an outsourced CFO, because they are going to need dual signatories around all cash movements. And so they're going to need the admin or the outsourced CFO to initiate the cash movements, and then they can approve the cash movements. Another key sort of clause is going to be having an ironclad backup in their LPA to explain what the key man provisions is, because If they're a solo GP, we typically will see that the LPAC would step in if anything unfortunately were to happen to them. And so that's another huge consideration when there's just one GP.
Awesome. Graham, back to you. I know you're very disciplined when it comes to portfolio construction and planning. How often do you see fund managers significantly shift their portfolio construction strategy mid-deployment, either based on new learnings or failure to gain allocations? And how do you help them approach this?
Yeah, I think it's more common than you'd think. Like a portfolio model is necessarily, it's a guide, right? Like it's a blind pool of capital. You don't know how it's actually going to be deployed, and we like to talk through in advance of committing what a GP thinks their portfolio is going to look like. But we also want people to reasonably react to market conditions and adjust if they think there's a different optimized construction. So we actually see it a lot. It tends to be kind of more marginal, like we're going to do a handful more shots on goal here and subsequently reduce our reserve allocation by 10-20% versus something much more dramatic. But I would say most fund managers that we back over the course of a 3 or 4 year investment period come to us with some refinement in terms of their portfolio construction. So it's not something I would shy away from if I was a GP. Again, I think communication is key, and you want to talk to your anchor LPs about what the right go forward strategy is. But I think smart, thoughtful LPs recognize that a model is just that, and that you have to adjust sometimes.
Awesome. Yeah, I think it comes back to communication as well. It's better for you guys to learn about it much earlier than when it's sort of on fire. So that's great. Liz, going back to one of your earlier comments on GP friendly versus LP friendly, what are some examples that you've seen that in an LPA that tend to stray more to the GP friendly direction, especially for like an emerging manager?
So what we are seeing are things like back office fees being charged to the fund, and typically those services should be paid by the management fee. Internal salaries of employees and their total comp package should come out of the management fee. We're also seeing an uptick in things like that you wouldn't typically see being charged to the fund. So like a third-party fund admin fee can be charged to the fund. That's market. But charging a compliance consultant or your IT consultant or your IT stack to the fund is off market, right? So some of those things should be being covered by the management fee. We're also seeing an increase in the charging of transaction fees. We've had 3 or 4 managers in the last year charging things, it varies, but from like a $1 million admin fee for every deal they close to the portfolio company. And so things like that we are looking at, wider scope around things like, if the fund has first right of refusal and doesn't see that investment opportunity as something for the fund, the GP can then invest in that opportunity. Or the GP already has an underlying investment, they did a seed round, and now it's become an investment opportunity for the fund. Fine, but like I said, we want to see some sort of conflict of interest, structural mitigants built into the process. So if you're the GP who's already invested in that portfolio company, you have to recuse yourself from the IC vote. You have to get LPAC approval, things like that, to make sure that again there's an alignment of interest between the GP and the LP base, and that's kind of what we're trying to attain by having these sort of open dialogues with our GPs.
That's great.
And I'd add one thing, Nick, on the kind of LPA negotiation from the investment side. I mean, we're more frequently seeing triggers to premium economics in LPAs, which, look, we are open to having that conversation. We kind of, the two things I'd say is like, we kind of see that as an earned clause, right? There has to be some historical outperformance to warrant that conversation. And then B, it needs to be a trigger that makes sense. Like I'm not going to pay 30% above a 3x. Like that's not what we're doing venture for. So those are the two pieces of feedback I'd have for GPs on the thinking through triggers to premium economics.
Yeah, yeah, and this kind of plays into a question we had submitted around like very early managers using sort of template out of the box documents from platforms like AngelList or others, where maybe they're sort of like, oh, this is standard. I haven't really personally drafted this in any specific way. What is your advice on like them, whether it's working with counsel or getting advice from their anchor LPs about figuring out what adjustments need to be made to those and what should matter to them before they like kick off fundraising?
Is that for me or?
I guess yeah, either of you guys, yeah. If one of you guys want to hop in.
I mean, so I guess so the question is, what advice do we have for GPs where they haven't actually had a big hand in some of these more onerous clauses in the LPA and how they
Yeah.
can better negotiate with their LP base on that?
Right. They're using a template one that they're told is standard, but they haven't really dug into like the type of discussions you guys are thinking about now.
Yeah, I mean, we do see that a lot. They've just relied on their counsel to draft it, and their counsel's told them again that they've drafted, 15 of those in the last month. But what I would say is, you're the founder and the owner of this business, so you should know the terms that you're asking your LPs to sign up to. And to Graham's point, you should be open to the feedback that you're getting from your anchor LP base. Because, StepStone, we're investing in hundreds of VCs on an annual basis. And so we are seeing what is considered market, what, institutional investors need to see in the LPA, what sort of protections we want to see. And so listening to that feedback, listening to your LPs is key to that negotiation piece. But focusing on, a circle of 5 or 6 key LPs versus going out to all of your LPs is going to make the process much more efficient.
Very helpful. Awesome. I see another one that came in. Can we please dive into exits through secondary transactions? Is providing earlier liquidity to LPs more important than holding out for potentially higher returns through an IPO or acquisition? Either of you feel free to step in.
Yeah, look, I think it's a critical question, and it is more art than science. Like you never want to see people selling a equity in a high potential company too soon. Now, I think you do have to balance that with if you've been holding on to an asset for 7 or 8 years and you invested at the very earliest stage and it's reaching a level of maturity and honestly a valuation threshold where taking some of that capital off the table can be meaningful to your fund. We think that's where it becomes kind of a fiduciary responsibility to at least start to consider it. So the guidance we provide is like, never sell the whole thing, because it is a game of capturing upside and power law matters. But B, selling 10 or 20% of a position, along the way isn't unreasonable. And it's something that we've seen Cendana GPs execute really effectively. So we're very much in favor of that. I wish I could give you like a prescriptive, like, here's how much to sell exactly when. But the truth is there's no right answer there. I mean, some of it is, trusting your instincts as a GP to say, well, like, actually this round feels fairly overvalued. So like, maybe I'm going to take a quarter of my position off, or like, look, I still see a 10x from here. So, sometimes the reasonable decision is not to monetize anything. I think what we want is a thoughtful framework once a position gets big enough to be impactful to fund performance. And again, that we want that communication from the GP, like, here's how I'm thinking about this decision to pursue secondary or not to.
That's great. And when you say they conversing with you, usually maybe they're doing through the LPAC or discussing with your LPAC. Can you talk about maybe how that dynamic comes into play when GPs are working with their core investors? Either of you are welcome to jump in there. I'm just curious to get your insight.
Yeah, I'll take a shot and then Liz jump in with anything I missed. We're on the LPAC of all the funds that we back, but honestly, our relationship with the GP tends to be we're communicating much more frequently than any like formal governance event. So we do monthly calls with just about every GP that we back at Cendana. And our expectation is that our GPs will come to us and preview any issue that might warrant a discussion at the LPAC, again, well in advance. So back to that recurring theme of like open communication and transparency. We want to be a sounding board and we want to have that conversation with our GPs as early as possible. And then hopefully we can kind of mutually agree on a path forward to have a vote as an LPAC if it's something that requires that level of like check the box governance. But it doesn't always, right? Sometimes it's just like an exchange of ideas that can happen outside of a kind of the formal LPAC construct.
Yeah, what I would just add to Graham's point is, we've had some GPs that have been undergoing an SEC exam and they haven't been upfront or transparent about that, either to the individual LP base or the LPAC. And I think you're walking a pretty tight rope there because, one, if you don't get in front of it, like Graham said, and you aren't transparent and you do suddenly get a fine or there's a material litigation that hits the news, or you've had material turnover at the investment or back office side and you haven't shared this with your LPs, it's going to erode trust. And it's key that you do get in front of all of these things. And some legal counsels will say, you're under no obligation until the exam's complete to share this information. But if it comes out of left field, I can tell you that it's going to give your LPs pause on whether or not they want to re-up at the next fund.
Yeah, not necessarily what's required, but sort of what's expected. That makes sense. Well, you guys have been great. I'm gonna do one more because I know I've been hitting you with a ton of questions here. And either of you guys can jump in or both. Absent realized returns, what are some of the must-haves you expect to see in a one-pager or pitch, as well as questions you would have for an emerging manager pitching a fund two?
Again, our focus on portfolio construction, I really want to know how you are intending to execute this fund strategy. How many deals, typical check size, valuation thresholds, do you have ownership targets? Are you holding any capital back for reserves? And how that construction might have changed from a fund one and how you're confident that you're going to be able to execute that without any erosion in the quality of deal that you're getting access to. So again, it's just the blocking and tackling of like how you plan to build the fund. I think that's a kind of critical piece to any one pager.
Yeah, and what I would add also is as you're raising fund two or fund three and you have established a track record, being honest about what worked and what didn't work is key because we don't expect every single one of the portfolio companies to perform. But we do expect you to be able to share your thoughtful response to why things went well and why things didn't go well. And again, if you're having to sort of change or adjust certain aspects of the strategy to fit the market, explain that too, because it's going to give more credence to the best performing pieces of your portfolio if you've been honest about the bad or worse performers and you can actually articulate the reasons behind that.
Great. Yeah, it sounds like there's a ton of other storytelling to do outside of returns itself. So that's great. But with that, I'm happy to wrap things up. We can quickly pop a poll back up for anyone who missed the first time around if you want to stay in touch. But love to say thank you so much to Liz and Graham for joining today. And a big thanks to all the listeners. Really appreciate you guys sticking around and giving some great questions. As mentioned, we will be following up in the coming days with a recording of this and a write-up, so we'd be happy to share that with you. But thank you all so much. Really appreciate it. And I hope you had fun and have a great rest of the day.
Thanks so much. It was a pleasure. Cheers.
Yeah, thank you. Bye.